Hello everybody, and once again welcome to Synonomics. As promised earlier, I'm going to cover today the Magnificent Seven, which had a stellar return this year in calendar 2023. But before that, let's look at the financial markets and some of the economic data that was released yesterday. So US actually released its jobs data. So 339,000 jobs were created in May, as comparison to 190,000 expectations. So that's pretty strong, by the way. Having said that, the unemployment rate, which actually rose to 3.7% from 3.4%, is actually going to put the analysts into a state of confusion. And now everybody is guessing that Federal Reserve is going to put a pause on the interest rate. Please let me know in the comment section what you think. On one hand, it's showing a strong economy. On the other hand, it's showing increase in the unemployment rate. By the way, my understanding is that, which is also pretty much logical, I would say that this simply shows that there is plenty of jobs in US, but maybe there has been a lot of layoffs for senior executives, and probably they are finding it difficult to find the job. And that's why the unemployment rate for this particular month is slightly higher. So not a big deal, because overall, if you look at that 339,000 versus 190,000, expectation is stellar. Other than that, there was another market actually enjoyed it, and there was a unique phenomena that was observed, and that was broadening of the market. So far only these Magnificent Seven that I'm going to cover today had been growing, and the rest of the market was not doing very well. So if you look at from Dow perspective, Dow has been pretty much flat this whole financial year. And yesterday, Dow increased 701 points in one day, the largest increase in this year. Same with the S&P 500. So the market is broadening away from this Magnificent Seven. And the good news is that a lot of other companies like Caterpillar, for example, had 8% run. So increased 8%. If you look at the S&P Energy Index, that went up 3%. Similarly is for the materials, etc. So the market is now broadening, and that's a very good sign, because so far it was looking that it was pretty much concentrated at this Magnificent Seven, which is not the case now. And if you look at Dow, for example, it actually closed at around 33,700 plus. Let me remind you that its 52 weeks high is 34,721. Not only that, NASDAQ, because away from this AI gold rush, it actually looked at the other companies as well, which had been left behind. NASDAQ, in fact, closed at the record high, 52-week high, 13,240. So the market was enjoying the whole economic data as well as the US debt ceiling resolution. Now I'd like to highlight your attention, or I'd like to focus your attention more towards the other economies as well. For example, India. India is on its stellar run as well, though it's not at the record high or not 52-week high. Nifty 50 is at 18,500. Its 52-week high is 18,880. And Sensex is pretty much at 62,500. Again, its 52-week high is slightly higher, around 64,000. So they are pretty close there. Australian market, on the other hand, also closed slightly higher. So ASX 200 closed at 7,140. Its 52-week high, by the way, is 7,567. It's a beautiful number. It's a little bit away from that. Now, when you look at the overall return perspective, you will see that Indian market is actually outperforming the whole world's index everywhere. And I'll give you the number for you. So Nifty 50, on the other hand, the 1-year return is 12% and its 5-year return is 72%. If you compare that with Australia, and to make it apple to apple comparison, we'll take ASX 50, the 50 top companies. So ASX 50, which closed at 69.50, around that. Its 1-year return is negative 1.4%, and its 5-year return is 18.7%. So 18.7% versus 72% in India. It's a big difference. For some of you who also think that there is a currency depreciation, the valuation of the Indian rupee is slowly depreciating, right, as compared to US dollar and other currencies. So I have done the maths for you. With Australian dollar, it actually depreciates roughly 1.5 to 1.7% per year. So if you look at even the 5-year return, even if you take 2%, depreciation is 10, but the growth is 72%. So guys, the net, it's still US dollar, in Aussie dollar, it's 62% increase versus 18% for ASX 50. Same is the story with ASX 200, which is the wider index. So its 1-year return is negative 1%, and its 5-year return is negative 18%. So Indian market, I like to focus your attention towards that. In fact, I'm going to cover Indian market in a separate episode very soon. So stay tuned. Let me know what you guys think about it in the comment section. Now let's focus now, coming back on the Magnificent Seven, and they had a stellar return, as I told in the beginning. So let's look at their returns, by the way. So Apple grew 37% this calendar year from January to May. Microsoft 38%. Alphabet, which is Google, 39%. Amazon 44%. Tesla 66%. Meta, which is Facebook, 120%. And Nvidia is the highest at 169%. I beg your pardon. So Nvidia 169%. So all these IT indices overall actually has now sitting at a P of around 26, 26. Whereas S&P 500 is around 16, 17. And especially the S&P 500 cyclicals are at 15.5. They're pretty cheap, by the way. And let's look at some of these Magnificent Seven price earning ratios to see which stocks are expensive from the PE perspective. Though price earning ratio is not a great indicator, I tell you, because it actually doesn't take into account the cash flow. See, if the company is a cash churning machine, definitely the market will give higher premium to that, higher multiple to that. On the other hand, if the company is one of the fastest growing company like Nvidia and others, all the other Magnificent Seven that we are talking about, again, the market will definitely give higher P. Who is not regretting today not to buy Apple at 50? 2016, when Warren Buffett was buying Apple, it was at something like 80 at that time, and Apple has split 4 times, 1 to 4. So actually Warren Buffett was buying at much cheaper rate. Right now the latest price is 180. So Warren bought it at around 40. So anyway, at that time also Apple was not very cheap. So let's look at the price earning ratio of these Magnificent Seven. So all of them actually are hovering towards 27 to 35. Like Apple is at 27, Microsoft is at around 35, Meta is around 30, 28, etc. The most expensive in this category are actually Nvidia. Yes, you have guessed it right. Nvidia. At 2023 earning, it's at 160. 2024 earning, it's 64. 25 earning is 48. 26 earning is 38. So you can see how it's declining. The price earning ratio is coming down. So if you buy it and hold it and look at from the FY26 perspective and discount the cash flow accordingly, you are actually getting it at 28. So pretty good actually, 28 or 38 actually, if I remember correctly. If you look at Amazon, on the other hand, who may not be growing as fast as Nvidia, is actually at quite high, something like 16, 60p, 60. And even if you look at from 24 perspective, it's at 52 or odd. So pretty much, I think these two stocks are pretty expensive from the P perspective, price earning ratio perspective. For some of you who are new, I'd like to explain what is price earning ratio. It's the most commonly used and most widely used index, or the ratio I would call it, to analyze the fundamentals of a stock or a company. So the price you are paying divided by the earning per share, how much one share earns. So you divide the number of shares with the total profit, that will give you earning per share, EPS. And you divide price with EPS, that will give you price earning ratio. It simply shows that what price you are paying for one share versus its earning. So when we say that Apple has a price earning ratio of 37, that means you are paying $180 as a price, and its earning is 180 divided by 37. You do the maths. So that's how it works. So coming back to that, now the question is, after all these analyses, the question is that, guys, is still the time to buy? Let's look at some of these stocks. Of course, some of these stocks are a little bit high. They have gone up. For an example, if you look at Nvidia, 159% increase. If you look at Meta, for an example, that's another 120% increase this year in 5 months. Having said that, they had come down anyway. But if you look at the stocks out of these 7, by the way, let me highlight here that Microsoft actually hit 52-week high yesterday, 339, 340, like that. See, if you look at that, I personally feel the stock which has declined drastically is Tesla. It's pretty much sitting at 40 to 45% down from its peak. So it was trading at around 300 plus last year, 390 in fact. Yesterday it has closed at 213. So as I mentioned, it's a 66% increase this year, but it has come down drastically. In fact, it's not in the 1 trillion club now. It used to be 1 trillion plus. It actually achieved 1 trillion plus in November 2021. And now its market cap is around 700 billion. So you can see it has declined drastically. Of course, it had some challenges from the supply chain perspective in China market. At the same time, with the increased interest rate, the purchasing of the cars, especially like Tesla cars, has been impacted. Having said that, there are some good news around that as well. Now Tesla is the most respected brand in the whole world in automotive industry. It used to be Mercedes-Benz, followed by Toyota, but now it's Tesla. And its brand value, according to Brand Finance company who actually does that, is $66 billion. Having said that, guys, if you look at the EV, electronic vehicle, which is supposed to grow at 18 to 20% CAGR, till 2030, Tesla is going to be the obvious beneficiary in that. So in my personal opinion, I think it's time to buy Tesla. Very soon you'll see that crossing, I would call it 300. Yesterday it has closed at 213. By the way, in last 1 month, it had a stellar run from 150 to 213. And if the market continues to go up, which looks like the market is riding the wall of worry, that's what they call it. The market is riding the wall of worry. And if that continues, Tesla will perform and you'll have a big opportunity out there. Having said that, these are my personal opinion. Please don't invest based on this data and based on my analysis. I would request you to consult your financial advisor before making any investment decision. All these analyses, etc., are for entertainment and education purposes. So with that, as I mentioned, I will actually cover India in more details in the subsequent episodes. I'll just like to highlight here that there was a survey done by, I think, 87 emerging market fund managers, and all of them are saying that India is overweight. Because China, there is a problem. They're not very transparent, by the way. It's not easy to bring money out from China. Mark Mobius, who actually manages now the Mobius Capital, used to manage one of the emerging market funds. He said that he has sold stocks in China, but it's very difficult to bring the money out of China. And that is actually putting the fund managers down. They're a little bit worried about it, right? So India is the obvious destination now. And with 7.2% GDP growth rate, India is the fastest growing country in the whole world. And if you look at Morgan Stanley Capital International, MSCI, Emerging Market Fund, now India has got the third highest allocation. So China is still number one, 31%, followed by Taiwan, 15%, and then number 3 is India, 14%. So very soon it will be second. And they actually allocate that based on the market capitalization. So it's pretty much like a mathematical calculation. So with that, have a great weekend. And once again, please don't forget to like, share, and subscribe, and hit the bell icon. Thank you very much for your support. I'm getting a lot of comments, which is quite encouraging. Keep sending your comments, and also let me know which topic you'd like to cover. Slowly, I'll move away from these financial markets to the other 4 M's: meditation, motivation, music, and malt. A few requests have come that they are looking forward to hear something about malt. So very soon you'll hear that. So till then, it's goodbye from me. Have a great weekend. Thank you, everybody.